quite frankly, we're in a bubble. PE ratios are way out of whack. These tech companies with just obscene valuations, meme stocks going up 200% in a day. It's, in general, a very dangerous time to invest once you look past the curtain of sunshine, rainbows, and a bull. Hey, my name is Tucker Kraus, and welcome to my channel, where I'm going to be detailing my investing journey as a 14-year-old and giving my thoughts and opinions on a variety of personal finance related topics and issues. In today's video, I'm going to be going over how I'm investing into an overvalued stock market with very limited capital as a teenager. Now, despite me saying that the market is an overvalued bubble, I still am holding most of my money in the stock market as a hedge against inflation, as I believe that's the best idea, as when you're holding cash, you are guaranteed to lose it. On your screen now is the value of the US dollar since the Federal Reserve was established in 1913 up till 2011. So clearly, it loses a lot of its value. So whether that's Benjamin's or funny Canadian money, which totally is not monopoly money, don't hold cash. So first, why is it a bubble? Stocks, they only go up, right? That's what everyone on Wall Street Bets says, and they're, of course, the safest investors, right? But as the saying goes, when even shoeshine boys are giving you stock tips, it's time to sell, as Joseph Kennedy said, who was actually the father of JFK. I just found that out when I was trying to find the exact quote. But on the surface, I know I fall into that category, but let me explain to you why I don't think that's the case and why I think there is much worse people to apply this example to. The easiest target would definitely be these TikTok gurus that are going like, oh, well, I buy the stock and then I sell it higher when it starts to come down. People who say that kind of thing, which obviously is extremely obvious and is not advice at all if you're not researching the company, because it go anyway. It's frankly stupid. They're doing zero research, which at least I do. And they also have an audience of millions of people. And so millions of people are paying no attention at all. They're just downloading Robinhood and sending it into Tesla or GameStop. And it's just frankly a terrible idea. But again, I'm not a financial analyst. For everything I say, you should be doing your own research. But one thing you don't have to research is how to smash that like button. It's just right down there. Should be just below the video. Make sure to do that. Now we can get right back to the video. In both the stock market space and the crypto space, we're seeing the rise of things like GameStop and Doge, these memes that are just blowing up out of nothing. I'm not trying to be like super boring saying you shouldn't do it. Go right ahead if you want to lose all your money. I just think it's very dangerous that the market is being treated like a casino and not as a market. Alongside this, many companies' evaluations are at all-time highs and just at ridiculous highs that are just horrible value. Tesla is that clear flagship. But this is all just the retail response to the biggest issue, which is the Fed's money gun.
Haha. Money printer go
On your screen is a graph of the M1 money supply. The amount of money printing is absolutely insane and reckless. Food prices in some places are already on the rise, but that inflation has mostly been seen in the stock market. So eventually the Fed, no matter how much they try and avoid it, will be forced to pump interest rates. This will basically tank everything. And that is the reason why they just continually print to continue inflating this bubble so they don't have to take the blame for crashing the market. It looks good on them if they just keep inflating it more and more. So how long will it take to crash? Frankly, I'm not sure. But it is certainly going to happen. Now, let's get into some of the strategies that I am using to avoid taking too much damage when the bubble finally bursts. First, when I look at companies, I try and look for ones with relatively low PE ratio compared to being like obscenely overvalued out of this world, right? I don't want that. I want someone with a relatively low PE ratio. Take ExxonMobil and Tesla as two examples. Tickers XOM and TSLA. Keep in mind that as I go over this, I do have shares of XOM. Just want you to keep that bias in mind. This graph shows the price to earnings ratio of both XOM and TSLA over time. Aside from Q4 of 2020, XOM has remained fairly stable in the range of 20 to 40 in their price to earnings ratio, whereas TSLA has climbed massively to over 1,000 times their earnings, which is just insane. So if you're someone like me who's a teenager with very minimal capital, buying something that is very overvalued will lose you a lot of money, eventually. It'll seem great right now, but eventually you're going to lose all that. You should just keep that money in a safe, stable, much slower growing stock, as when you lose that minimal capital, it will be much harder to get back. So following a very similar train of thought to what I just detailed, I've invested into blue chip dividend companies rather than these hyped tech growth stocks. To be fair, this means I haven't made quite as much money as these people who bought Apple, Amazon, Tesla even, back in March of 2020, right? But it does mean that when this bubble bursts, I'm gonna be hit a lot less hard, as I would much rather have my portfolio grow 10% and drop by 25% than have it grow by 20% and have it crash by 45%.
Editing Tucker here. I didn't think to add this in initially. Pause if you need to, it proves my point.
All these stocks like Apple, Microsoft, Tesla are going to crash a lot harder when the crash comes, due to the fact that all these retail investors piling into them are going to sell at the first sign of a loss, right? Just look what happened at last week, start of March 2021. There was a very minor crash and all these people were panicking like their lives were over. Whereas dividend collectors, they never sell. They will see it dip and they will dollar cost average all the way down to the bottom and ride it all the way up. And because lots of dividend collectors don't sell, the stock won't crash nearly as hard in the first place, creating a much better safety net for your money. Which is obviously a good thing, since if you have very limited capital, you only have a few $1,000s, you definitely don't want to be losing that, as it is very difficult to get back. It's of course good to risk some capital, but you also don't want to just YOLO it. It's a lot better if your $2,000 drops by $200, as that compared to, a growth portfolio. Even though it might be worth a little bit more, it's going to drop a whole lot harder. And it's because it is a much larger percent gain required for the larger percent drop to get back your previous capital. During bear markets or corrections, you want to be dollar cost averaging down. That's always a great idea. But if you have very limited capital, dollar cost averaging down is very difficult. Let's say a stock you really like goes from $100 down to $90 and you only have $300. I'm stuck in a situation similar to this. But what I would say instead is look for a stock that you like that is about $50 and goes down to $45. So an equal amount of percentage drop, the stock itself is a lot cheaper. So what I would say is if it's on that same down day, you buy that cheaper stock, allowing you, if this bear market goes on for a long time, you can buy that same stock on the way down much further, allowing you to dollar cost average your small amount of capital a lot lower compared to if you just bought those three $100 or $90 stocks. As if it keeps going down, you're not going to be able to keep going down with it when you can only buy 3 times compared to 6 or 7 times. Well, hopefully I didn't ruin your day with all that bearish talk. But after all that, the absolute best way to protect yourself from a bear market is to smash that like button. No, I'm just kidding. But still definitely do that. But thanks for watching, and I will see you in the next video.